Welcome to the New Year, New Markets webinar. I'm your host, Becky Chandler, and just a couple of housekeeping items before we move into today's presentation. First, you're on mute, so don't worry about dogs barking and babies crying. No one can hear you. Similarly, we can't see your video, so if you have any questions, please use the Q&A button at the bottom of your screen. I'll get to as many as I can during the presentation, but if I don't answer your question, I will email you after the show. And lastly, yes, the slides will be made available. They will be sent to everyone that's registered for this presentation, and a live recording will be available on the aba.com, abaretirement.com website within the next couple of weeks. So thank you. Thank you for joining us. We can move to the next slide, please. Welcome to New Year, New Markets. I've had the privilege of presenting this webinar with Matt Parlengas, my partner in crime, for the past few years. Matt is a principal at Mercer Trust Company, who is the trust for the ABA Members Retirement Fund Program. We can jump to the next slide, please. I want to make sure everybody sees Matt's headshot there, which is just fantastic, youthful and all, and mine that is completely generated with AI. So thank you. Welcome to the show. Use the Q&A button. We're looking forward to engaging with you, so please feel free to interact as often as possible. We'll jump right to the next slide. We're going to go over the 2025 market in review. Then Matt will present a 2026 economic outlook from Mercer. We'll look at the ABA Retirement Funds investment platform. I'll share with you some program resources and information to help you make informed decisions about your retirement planning, and of course, the Q&A portion. With that, I'll hand it over to Matt.
Awesome. Thanks, Becky. Appreciate it. Looking forward to the agenda here. So if we flip over to the next slide, we can jump into our 2025 market review. But actually, before we jump into it, we wanted to start with a poll the audience question here. So if you don't mind putting up the poll. And I'll hopefully it should pop up on your screens momentarily. But which of these 2025 events impacted financial markets? So the DeepSeek AI model launch earlier in the year, Liberation Day tariff announcements, the new fiscal budget for the U.S. that passed by U.S. Congress, the One Big Beautiful Bill, the government shutdown, or do you think all of these had an impact on financial markets throughout the year? So I'll let folks give them another 5 or 10 seconds to respond, and then we'll see what you all think. And if we could maybe wrap up the poll, pretty quick question, rapid fire to start the afternoon. Just give me a second to for the results to populate. Sorry, normally it should pop right up on my screen. I could give you the big reveal.
It might pop up if you move to the next slide.
Oh, okay. Just getting the wrinkles out early on. That's fine. I'll give you all the answer. I mean, it was a little bit of a trick question to get the brain juices flowing this afternoon, but it was really all of these had an impact on the year. So looking out into 2025, it seems like an eon ago, but we started off the year coming in a pretty strong financial conditions coming from 2023 and 2024. These have been kind of recovery years from COVID. We'd had high inflation, but falling inflation, higher rates from the central bank, and really strong equity market performance in 2023 and 2024. So if you start the year in 2025, we started off with a bit of a bang. So what we're showing here on this chart is a number of different news events, but also we're showing the performance of different types of investments. So the dark blue line is the MSCI ACWI that includes all global stocks. The orange line is the MSCI emerging markets, and we're going to talk a little bit more about emerging markets in this presentation. So I wanted to highlight that. And then the Bloomberg Global Aggregate, which is a measure of global bond markets. So if you can see, just in the totality of the year, it was a really strong year, no matter what investment category you were invested in, or if you were diversified across all of them, and particularly emerging markets. This was the first year in a long time emerging markets had a very strong return. So wanted to call that out. But if we go just kind of a quick flyover of the year, and I won't go over every single one of these events, we had the DeepSeek tool launch out of China earlier in the year, and that put a lot of selling pressure on some very large, dominant U.S. technology stocks. There was a quick recovery there, but it kind of put warning to the wind that maybe there's other players in the marketplace, not just the large dominant US technology companies that could play and be meaningful, produce meaningful gains in artificial intelligence. But the real story throughout the year was the tariffs and Liberation Day. And you can see that big drawdown in the beginning part of April. So the announcement of really broad sweeping tariff measures throughout the marketplace that caused a pretty dramatic sell-off in stocks, a re-rating of bonds, and it kind of changed our economic forecast for the year, changed a lot of investors' economic forecast for the year. But the way it actually played out was a lot of these tariffs never really went into effect. They were used more as bargaining chips, and then there were deals struck, and markets very quickly recovered. You can sort of see the blue and orange lines very quickly recover after those tariffs. And then what shone throughout the rest of the year was just really strong economic fundamentals from the US and from other global economies. So strong consumer, strong capex, falling inflation, falling rates. I mean, these are all things that were really good for economic growth. And it ended up being a really strong year for investment markets in 2025. And this even included, if towards the end of the year, a U.S. government shutdown, a couple Fed rate cuts to wrap up the year. But again, things were kind of moved up into the right after Liberation Day. So let's jump into a little more detail. And if we go on to the next slide, we're actually going to cover this very similar to how we've done this webinar in the past, where we're going to look at the economy through three different lenses. We're going to talk about growth, inflation, and geopolitics. In the past, we had talked about it more in the lens of inflation recession because there was a lot of worry about us falling into a recession. Now we're a little bit more growth focused, and geopolitics are always something we want to focus on. And then we're going to look at what did we think going into the year 2025, and then what actually happened during the year. We can kind of grade ourselves and see what predictions worked out well, what predictions didn't work out so well. So first, thinking about growth. What we're showing here on the line is GDP forecasts throughout 2025 and 2026. And you can see that it was pretty volatile for GDP. You see that drawdown towards the middle of the year that had to do with, especially in the United States, the tariff announcements and then a subsequent recovery. So what did we think going into the year? We thought that growth was going to soften a little bit. We had two really strong years in 2023 and 2024. But we did think that there was low risk of recession. During the tariff announcements, we upgraded our view that there might have been a recession, and then that faded away as there were trade deals struck. But we also had a view that we were gliding into a soft landing, meaning that as the Fed was raising rates, as inflation was coming down, that in and of itself would not push us into a recession. And that's essentially what happened. So it was a really strong year for US GDP growth, and it really was driven off the consumer. So in the United States, the consumer represents about 70%, a little bit shy of 70% of GDP. So that's a lot more than other global economies, where the consumer spend is a little bit more than half, about 55% for other economies. And really, since the global financial crisis, US households have done an incredible job deleveraging. So household debt as a percentage of GDP is much smaller than it was during the Great Financial Crisis, which puts the U.S. consumer in a really strong footing, and they're spending. So there's an economist even at JP Morgan, Mark Kelly, and he talks about, I think there's a saying, when the going gets tough, the tough get going. He always says, when the going gets tough, Americans go shopping. And we've sort of seen that over the past few years, that despite tariff announcements, despite high inflation, despite COVID, the US consumer has been incredibly durable, and it's really a strong source of economic growth for the United States. Another thing that was beneficial for growth in 2025 is inflation coming under control. So that can cause a lot of economic uncertainty. It could lead to higher rates, higher borrowing costs. So all of that coming down on the balance is beneficial for the US growth and the US economy. And finally, this is a trend that had started in previous years, but really accelerated during 2025 was AI spend, and that the economic activity that's generated by this massive investment that we're seeing in artificial intelligence. And if we go on to the next slide, I wanted to dig into that a little bit further. So what we're showing here is the CapEx spending, so capital expenditures, basically investments made by some very large US technology companies in artificial intelligence. And you can see that it was kind of static throughout the late teens, 20 teens, and going into 2020, 2021, 2022. And then when you hit 24, 25, it really starts to accelerate. And this coincides with a lot of the developments from ChatGPT and a lot of the Gemini, a lot of these large language learning models. And there's a couple things to point out on this slide. It's not just one or two companies. It's a handful of companies that are doing this, and it's exciting for a couple of reasons. Well, first off, there's the scale. 2025 companies are estimated to have spent $400 billion on capital expenditures to support AI development. That in of itself is an astronomically large number. And then you look out for projections into 2025, 2026, where we're north of $500 billion spent just on artificial intelligence. So this is exciting for two reasons. First, that's just a lot of anytime a company or consumers are spending money in the economy, that's really just generating economic activity. It's, they're buying real estate, they're buying power, they're buying computer chips. It's great for the economy when corporates are comfortable spending capital. It's also exciting because of the potential of some of these AI, large language models, and other applications of AI that could potentially increase productivity within the economy and help make all sorts of different companies much more efficient, much more profitable, and that economic activity can pay dividends well into the future. So I think there's a lot to be excited about with AI spend. I think we know also that we're going to see if all of this is money well spent. I'm sure not every penny of it has been well spent, so there could be some volatility in this. But on the surface, in a time when there's a lot of economic uncertainty, particularly around tariffs or geopolitics, the fact that companies are willing to spend in this one area is a good sign and good for U.S. economic growth. So if we go on to the next slide, that kind of covers off growth. We'll talk a little bit about inflation. And this has really been a key story throughout the past couple of years since COVID and the post-COVID year. So what we're showing on the left-hand side here is US core PCE, which is the personal consumption expenditure index. And this is a way that the Federal Reserve and other economists can measure inflation in the economy. And you can see inflation had been low, kind of below that 2% rate until COVID. And then because of stimulus, because of supply chain disruptions, we had a very large spike up in inflation. And then over the past couple of years, that's come down as the Fed has raised interest rates, as the economy started to normalize. We've seen those rates come down. So what did we expect going into 2025? We thought that rates would continue to normalize as they had in 2024, but there was this key risk, and we were unsure. There was a lot of talk about tariffs. We were unsure exactly how those would manifest. So we had that as a tail risk going into the year that we'd want to monitor. So what actually happened? That tail risk materialized in the Liberation Day announcements, and then just the further discussion around tariffs throughout the course of the year. And so you can sort of see that trajectory that we were on in 2024 was disrupted a little bit. You see a little bit of volatility around PCE and actually a slight uptick. So one feature about tariffs, and for those of you who were able to join our webinar last year, I think it was last spring, about the tariff announcements, will know that tariffs are inflationary. They can cause a one-time shock to inflation because it's a tax essentially on imported goods, which increases the price of that good, is a one-time shock. But it can take a little while for that inflation to pass through to the economy. So it can take a couple quarters, if not a full year, for that pricing to flow through. And so that's why you're starting to see a lagged impact of that tariff, those tariffs. And you can start to see that inflation we think that it will still normalize around the 2% level. It just may take a couple more years based on that inflation that we've been seeing. So if you go on to the next slide, why are we confident that even with tariffs, inflation over the long term is going to come down? And a lot of that has to do with what we're seeing here on US wage growth. So what we're showing on this chart is two different measures of wage inflation. So there's average hourly earnings and then an employment cost index. And these are two measures. There's a lot of different ways. You'll notice that throughout this presentation and other economics presentations, that it's often good to look at two or three measures of something because there's nuances and quirks with different types of measures. So you can see that the employment cost index is a little bit more stable. It does some things to help account for people switching jobs. So if you move from a high paying job to a low paying job, that's not actually wages deflating. It's that, there's workers kind of moving around throughout the economy and taking different types of roles. But what we're seeing is a general trend since 2022 down in wage growth. So we think that this is a positive sign for inflation falling. Inflation is kind of a tricky thing because it has a self-perpetuating quality to it. So if goods are going up in the grocery store and workers are going and shopping and they're noticing their grocery bills higher, on average they're going to seek higher compensation or they're going to demand higher compensation from their employer, who then sees their employment costs go up because they have to pay workers more, which means they need to increase the costs of their products and services. And it can be a vicious sort of self-perpetuating cycle. So the fact that wage growth is coming down is a clear indication that that cycle is dissipating, which is really positive for longer term growth. So inflation, it's not a chemical reaction. It's not, the body is deficient vitamin C. Just give it vitamin C, and you know that it's going to solve the issue, the deficiency. It really is based on trust and faith that inflation will come down. I mean, theoretically, inflation could stop if everybody just decided one day to stop giving raises and stop raising prices. But the problem is it doesn't work that way. People don't, you know, they can't all get on. There's no possible way you could get everybody in the economy on the same page and all decide that. It needs to be managed through interest rates, through communication, through the actions of, hundreds, if not thousands of individual um, consumers and companies as they sort of negotiate their wages, negotiate their prices. So this gives us confidence that our base case is still intact, that we are going to normalize from an inflation standpoint it back down to around a 2% level. It just may take a little bit more time because of the tariff situation. Uh, the next area we wanted to talk about, and if you go on to the next slide, is geopolitics. And this is always going to be present in financial markets, and certain things may be very important from a geopolitical standpoint, but may not have massive investment implications. So that we came into the year with a number of armed conflicts going on around the globe, whether it was in Russia, Ukraine, the Middle East, between Israel and Gaza. And while they're really important events happening in the world, and they're very tragic in many ways. They don't have these particular conflicts have not had massive financial implications. It's still things we want to monitor. And certainly when Russia invaded Ukraine in 2020, that had a shock on investment portfolios that owned Russian stocks. But if you look at, Iranian stocks or not, or, Palestine, there's just not, broad economic exposure from these countries. Israel's a very small country financially. So it just has had a more muted impact. Um, the one big geopolitical issue we have seen is tariffs. Tariffs are a geopolitical issue because it deals with the way governments interact with one another and how they do business and their economies interact. So that's probably surprised a little bit on the upside, and it's sort of interesting to see how initially I think there was a view that these tariffs were the objective to actually collect revenue and to change a trade balance, but between countries. But the way it's sort of turning out and the way it's played out throughout 2025 and the earlier part of this year is essentially used as financial leverage or as a bargaining chip for either a deal or for some other objective. And we're starting to see that a little bit in the negotiations in Davos over Greenland, or the rhetoric, I should say, rather than negotiations around Greenland, and using tariffs as sort of a wedge is part of that issue. So I kind of skipped over. What do we think? Again, it's really hard to predict these sort of things. So I think this year we're not going to make a strong prediction on any of the armed conflicts, but we do still think that tariffs, as long as the current administration, views them as this tool, they're probably still going to keep rearing their head throughout the course of the next couple of years, and certainly going into this year. So that's how the geopolitical situation played out throughout the course of 2025. So next, we're going to talk a little bit more about how this impacted investment markets. But before that, we're going to try one more time with the poll. I'm hoping that we can get an answer on our end this side, but hopefully it pops up for you as well. But what was the strongest asset class in 2025? Was it US equities, driven by a lot of these large technology companies like Nvidia, Microsoft, Google, Amazon? Was it real estate? Was it emerging market equities? So think about Chinese stocks, Indian stocks, commodities, so oil, natural gas, wheat, corn, gold, steel, or was it US fixed income, so US bonds, whether it's corporate bonds or government bonds? I'll give folks a second. Hopefully it's popping up on your end. All right. Give folks a second. All right, it's looking like we're having a tech issue on the polling, so we'll probably just get past this, and I'll let you know on the next slide is going to be a big reveal, sort of where we landed for 2025. So if you want to flip over to the next slide, if you had guessed emerging market equities, that was the winner. Um, so what we have on the right-hand side of the page is a number of different investment categories, and then we plotted the performance of those investment categories in 2025 versus 2024. And I'll make a couple observations, but I'll sort of walk you down the right-hand side of the page. So at the top is the S&P 500, and that is pretty well known by a lot of folks on the call. But for folks who don't know, it's a measure of the U.S. stock market. It's essentially the top 500 companies. There's some nuance where not every top company's in there, but it's a really good representation of the broad U.S. economy, the broad U.S. stock market, and that has Apple, Amazon, Nvidia, all the companies, all the large U.S. tech companies. So this was a really strong year. It's been a banner year if you were an equity investor. So the S&P 500 was up 18%, and that's coming off of back-to-back years where the S&P 500 was up 25% and 26% in 2023 and 2024. So just to give you a sense of how powerful the equity markets have been the past 3 years, if you had invested $1 at the beginning of 2023 in the S&P 500, it would have nearly doubled by the end of last year, just shy of doubling. So that's 4 years faster than the long-term market average. On average, if you look at the total history of the S&P 500, it takes approximately 7 years, and that can depend on sort of when you invest. There's good periods and bad periods to invest, but that's more than twice as fast as you would normally expect your money to double, because of how strong the U.S. equity markets have been. It's retreated a little bit from 2024, but still 18% is a really, really strong year for the S&P 500. If you go down below that, the Russell 2500, this is a measure of smaller and mid-cap companies. They tend to be a little bit more risky, but they, over certain periods of time, can outperform, and they provide good diversification within an equity portfolio. That performed a respectable 12% essentially during the quarter, or during the year, and that matched what we saw in 2024. So still really strong returns from small cap companies. Where we saw the big differentiation is in the MSCI EAFE and MSCI EM, those next two bars. And those are international developed stocks. So think stocks in Europe, stocks in Japan, stocks in Canada, and then the MSCI EM, which are emerging market stocks. These are think China, India, Brazil, more emerging type countries, and their returns were north of 30%. So these are pretty astounding numbers for a category that's generally lagged over the past handful of years. So just a couple stats. Um, this is the first calendar year since 2017 where both developed and emerging international stocks outperformed the US equity markets. It's the first year since the 2008 financial crisis where they beat US equity markets by double digits, and it's the widest outperformance in more than 30 years. So it's been a really, excellent time to have that diversification in your portfolio, to own some of these companies outside the US. And that's really driven by a couple of major things. First is the weakening US dollar. So as the U.S. has instituted tariffs, as the independence of the Fed has been questioned, as the U.S. has pulled back from NATO, there's been a number of things that have caused investors to look for other opportunities outside of the United States. And you're starting to see some capital flows and some weakening of the U.S. dollar, some weakening in faith in the United States, and you're seeing that manifest in performance of international equities. The other major thing is valuation. So your international stocks, because they've underperformed for a number of years, they're cheaper than United States stocks if you just measure them on an equal basis on how much do you have to pay for a dollar of earnings in Europe versus a dollar of earnings in the United States. So in general, cheaper assets, it could be, if as long as the conditions are right, it could be a nice catalyst for outperformance, and that's what we saw last year. The last thing I'll mention, and this pertains a little bit more to EM than international developed, a number of some of the most dominant players you're going to read about in the Wall Street Journal, or just in your personal investing account, they are U.S. based companies. So ChatGPT, Google, these are Nvidia. They're all U.S. based companies, but the other cohort of large dominant tech companies are in emerging markets. So some of the strongest technology players in artificial intelligence are Tencent and Alibaba, two Chinese companies. And then the largest manufacturer of semiconductors, Taiwan Semiconductor, is based in Taiwan, which is an emerging market. They're actually the ninth largest company in the world. They're right underneath Facebook and right above Tesla. And it's a company that not a lot of folks have heard of, but they essentially have a monopoly on manufacturing computer chips. So NVIDIA is their largest customer. NVIDIA actually doesn't make their own computer chips. They design the chips, they design the architecture of that chip, but then they send it off to Taiwan Semiconductor to then manufacture. So they've built such an expertise in that market that it's essentially a monopoly in what they do, and they're incredibly, incredibly talented and good at what they do. And so that's another reason to have some broad international diversification, because if you focus just on the United States, you're missing out on some of the world's best companies that may happen to be domiciled in other countries. Um, Going down, moving away from equities, we have a couple fixed income categories. So the Bloomberg Aggregate, Bloomberg Long Treasury. It was a solid year to be a fixed income investor too. So bonds are traditionally more defensive. They don't, so you wouldn't expect a 30% up year in the aggregate, but strong performance from the Barclays Aggregate, despite some volatility in rates throughout the year. And then we go down to real estate, a little bit of a softer year for real estate, but a stronger year for commodities. That's that bottom line, up more than 15%. And underneath the hood, we saw a little bit of weakness in energy. Oil prices actually fell throughout the year, but gold was up 64% and continues to rally going into this year. I was just looking the other day at gold and silver prices, and I think gold was up about 25% just in January alone, and silver was up nearly 50%. So this does tie into sort of the weakening US dollar. So when folks are looking to invest away from safe assets in the United States, another traditionally globally accepted way to store value is through precious metals like gold and silver. So that's why you've seen a pretty dramatic rally in those assets throughout the year and then going into this year. So if we go on to the next slide, I did want to double click a little bit on valuations, because this is important and I mentioned it a few times, but valuations are looking a little stretched. So what we show here on this slide is two different measures of valuation. So a 12-month forward PE, that's price to earnings ratio. That's essentially saying how much are you paying for a dollar of earnings for a company? And then the CAPE ratio, which is a cyclically adjusted version of a very similar measure. But essentially, it's all trying to look at, are stocks kind of expensive relative to their history? Or are they kind of cheap relative to their history? And what we're seeing is valuations that are nearing dot-com bubble levels. You can see the orange bar and the purple bar both nearing the peaks in the early 2000s, late 90s. So before folks panic, there's a but in this scenario, that things are a little bit different this time. So unlike past cycles, when a lot of that run up in valuation was driven by speculation, what we're seeing here is true earnings backing up these companies. So looking into 2026, analyst estimates are showing anywhere between 12 and 13% earnings growth for a lot of these companies, which is really strong. That was a lot more than Pets.com was getting in 2000 when they folded. I think a lot of those companies were earning no profit whatsoever. And these companies are highly, highly profitable. So that is a positive sign. But we do know that it's not going to be a straight trip up and to the right. Things aren't just going to appreciate and perform well forever. There is going to be some volatility around earnings. There is going to be some volatility around AI. And then also it's worth it to know that a lot of the earnings are driven by a very small subset of names. So markets still remain very concentrated in the United States with the large technology AI players still dominating returns, but at least they're backed up by earnings in this cycle versus past cycles. So something we want to monitor, but we understand a little bit better that we're on firmer footing this go round than past cycles. So that kind of wraps up our section here on the year in review, but we did want to spend a little bit of time on to look at our outlook for next year. So unfortunately, we had one more poll question coming up next. I think we're going to skip past that because unfortunately, it looks like the polling's not working right now. So you want to click through again. We'll spend a little bit more time just talking about our outlook going into next year. So we'll look at it through the same three lenses that we looked at last year, a lens of growth, inflation, and geopolitics. So from a growth standpoint, we expect growth to go moderately higher. We think that in general, the consumers, like I mentioned, it's a consumer-driven economy, and as long as the consumer is looking good, balance sheets are healthy, consumers are spending, it should produce positive economic growth for the United States. We still also have the positive tailwinds of AI. That spending is going nowhere, as you saw. If anything, it's looking to increase over the next year, which is positive. But there are some risks to the downside when it comes to growth. So we're looking at tariffs. Tariffs clearly could represent, if they do accelerate or pick back up again this year, there could be some risk to the downside for economic growth. Um, we're also seeing some slight cracks in the labor market. So to separate labor from consumer, the labor market meaning employment. So 2025 was a year where job creation actually slowed a little bit from 2024. So if we do see job creation start to slow again throughout this year, that could put more pressure on family balance sheets. It could put more pressure on consumer spending. So something we want to monitor. And then the final thing is business uncertainty. So businesses love certainty. And if businesses are going to make an investment, let's say I was a firm that made an industrial part, a certain type of pipe fitting for industrial application, and I wanted to set up a new factory in the U.S. to potentially export more parts to Canada. I could have if there was a stable regulatory regime, wasn't worried about tariffs, I could feel confident making that investment. That would be a profitable investment for my company. If I'm really not sure what's going on in the tariff environment, if I'm really not sure what's going on with geopolitics of the economy, companies tend to hold on for making investments. So if economic uncertainty still remains high, we could see growth come in softer if corporate players are less confident in making those investments throughout the year. But I'm still optimistic about the long-term benefits of AI and certainly the CapEx coming into next year so that it's kind of a balanced view, which makes us moderately constructive and think we're going to have some modest economic growth next year. Looking at inflation, like I mentioned before, I think we're on a trajectory where we're going to land at a neutral rate. We're going to hit that soft landing, and that inflation is going to gently nudge down to the 2% long-term target. But there could be some volatility around that depending on the lagged impacts of tariffs. We're starting to see that now. And certainly if there are additional tariff announcements throughout the year, we could see additional shocks to inflation, but we think that those are kind of transitory. The nature of tariffs is it's sort of a one-time increase. Inflation and tariffs don't increase every year. It doesn't make inflation increase every year unless the tariffs actually go up every year. So if it's a one-time, 10% tariff, you're going to have that 1% price hike up, and then everything will sort of fall back down as rates hold. It could have some volatility around Fed policy throughout the year. So we're predicting, and the market's sort of predicting that the Fed might wait a little bit. So we're thinking about 2 cuts this year, starting in July. And a lot of that has to do with some uncertainty around the lagged impacts of tariffs, but also some of the softness I mentioned in the labor economy. That's stuff that Jerome Powell mentioned that he's looking at and could potentially lead to a pause and pushing out further rate cuts towards the second half of the year. Globally, in developed markets, we're also seeing, I know this is kind of a US centric view, but globally, we're seeing most developed markets in a similar situation, but to varying degrees. So the British Central Bank looking to potentially cut alongside the United States. The ECB, European Central Bank, has already done some cutting. Japan's in a very different sort of scenario, but I think throughout most of the developed world, we're seeing a very similar situation of inflation falling and then central banks cutting rates alongside that. Finally, for geopolitics, again, hard to make a prediction here. We're gonna punt a little bit, so we definitely won't make a prediction on any of the armed conflicts, but we do think that geopolitics are going to be impacted by tariffs, and we're starting to see that even in the beginning of this year, as I mentioned, with the the World Economic Forum in Davos and some of the commentary about tariffs and Greenland there and the economic volatility that that can bring. So those are our just looking to monitor potential future impacts as we go into the year. And then next we'll break this down kind of one layer further if you go on to the next slide. And we'll look at, so how do those economic views play into our views for different asset classes? So overall, we're neutral in equities, and it's kind of a balanced view similar to economic growth. I think there's some things working in our favor, some things not working in our favor. So um, clearly valuations in the United States are kind of expensive. That could put a lid on, or put some downward pressure on U.S. stocks. But U.S. stocks are also, or U.S. technology companies are also spending so much money on AI that that's a really strong economic impulse as well. One thing we're also taking a look at and monitoring that kind of balances this view is while earnings and investment have been really strong in the technology sector, they've been a little bit softer in other areas of the economy. So even though some of the largest technology is the largest sector of the US economy, the largest stocks in the index are all technology stocks, there's still huge parts of the economy in finance, energy, materials, industrials, consumer names that there could be some softness in earnings going into next year. Um, Looking over into, and I just want to make a quick comment too on equities. International, even though it had a really strong year last year, that's 1 year out of the last handful where they've underperformed. And if you still look, even after that big run up, valuations in international equities still look attractive relative to US equities. So if you were to, it's just a good time. We never really recommend making a big swing one way or another, but it just highlights why you want to have diversification in your portfolio and not just bet on US or not just bet on international companies, but to have a really balanced portfolio that has some exposure to both. And we think now is a really good time if investors haven't been topped up on international to make sure you're topped up and you have a weight, a certain portion of your portfolio for diversification reasons in international stocks. On the fixed income side, it's going to follow the path of inflation. So if labor markets are a little soft, if inflation is sticky, a little bit sticky on the upside, it may cause central banks not to cut. But also conversely, if labor markets recover a little bit, they remain somewhat strong, and inflation does subside a bit, you could see rates fall, and that all has an impact on fixed income markets. And then when you look at credit, and credit is the more risky part of the fixed income market. So looking at corporate bonds and high yield bonds, those sort of things where you have to be paid an additional risk premium to hold those versus government bonds. Spreads are really narrow, meaning you're not getting paid a whole lot extra to hold IBM shares or IBM bonds versus government bonds. So you still get paid a little bit of a premium, but that premium's kind of thin right now. So I'm not looking for extra outsized returns next year from credit markets. Finally, in alternatives, I'll focus on sort of two areas here. One is real assets. So we're seeing a lot of opportunity in secular growth areas like data centers, in renewable energy to power those data centers, in logistics. Those are still some stronger areas within real estate and infrastructure. And then within the commodity sector, it's been a really strong year for precious metals. And again, we don't recommend making a big swing into precious metals, but it is it highlights why you want to have some exposure to stocks, bonds, and commodities, natural resources, other areas that are more inflation sensitive and that have different characteristics than traditional stocks and bonds, of which precious metals could be part of a well-diversified portfolio. And we can talk a little bit more about how you can access some of these investments within the ABRF program. So happy to take questions on this when we get to the Q&A section. I know that we had already had some questions submitted, but before we hop over to the Q&A section, I wanted to talk a little bit about the program. So if we flip to the next slide, and I'll have you go one more actually. So there's a whole lot of items on this list, but these are the investment options within the ABARF program. And we kind of divide them into 3 tiers to help organize them into different types of funds. So the first one, that make it easy for me, these are pre-mixed portfolios that are well diversified right out of the box. So the retirement date funds are meant to be invested by a participant who wants to retire in a certain year. And it starts off very aggressive and when you want to grow your balance, but then as you start to near that retirement age and your time horizon starts to decrease, the funds automatically get more and more de-risked. So they start to invest in more safe and secure assets along that glide path to then land you at a spot where you have a more conservative allocation. Even when you get down to the 2030, 2025, and the post-retirement date funds, it's still going to be a balanced portfolio. It's not purely focused on capital preservation, but it's going to have a more conservative blend of stocks, bonds, and real assets sort of within that portfolio versus a 2060 fund, which is going to be very heavily weighted towards equities and growth assets to help you grow that balance when you have a very long time horizon. The target risk funds are similar. They don't move over time like the retirement date funds, but they instead target fixed allocations to, a more risky allocation, a more moderate allocation, a more conservative allocation to help target different risk and return levels across a spectrum of three separate funds. In the middle of the I'm saving for retirement section, we have a number of individual asset class funds across active and passive management. So this is a way you can build either a fully active or fully passive portfolio of different types of stocks. So if you want to build a stock and bond portfolio that blends some active and some passive management, you have a number of different tools in here to help build your own asset allocation based on your goals, your objectives, your personal risk tolerance. There's also some diversifying assets in here, the real asset return fund and the alternative alpha fund, which can be used as a complement to some of your core holdings in stock and bond funds. And then finally, we have the retiree tier, the I'm almost retired, or I'm retired or almost there tier. And this is just to help investors who want to think, who are nearing retirement, who want to think a little bit more in an objectives lens versus an asset class lens and target different outcomes. So I want capital preservation. I want to focus a little bit more on income. I'm nearing retirement or I'm in retirement. And those funds can help are really tailored to meet that specific objective. And you can do a blend of those funds or invest in a single fund based on your objective. So maybe I'm worried about longevity. So I want to have a little bit of growth in there, but a little bit of income and a little bit of inflation protection. And I'm not super concerned about capital preservation because I think those other three buckets may suit my needs. And if you go on to the final slide, because I do want to leave a little bit of time for Q&A, there's no free lunch in investing. So what we do here is we mark off all the investment funds available within the program on a spectrum of expected risk and expected return. So typically in investing, if you want to earn a higher level of return, you have to take higher risk. And some of the more risky investments, but potentially higher returning investments in the program are things like small cap stocks, things like international equity. And you can see that up in the top right-hand side of this chart. And then the program also has some very conservative investments like the stable asset return fund and the bond index fund. Those are very conservative if you're worried about capital preservation, but they don't grow as fast as other asset classes. So you have a wide spectrum of different investment options throughout the program that we believe gives participants all the tools that they need to build a fully diversified portfolio based on your personal situation, your risk tolerance, and your risk, your time horizon, and your risk and return objectives. So with that, I'm happy to pass it over to Becky.
Thank you, friend. We can just jump right to the next slide. I know that's a lot of information, and I'm seeing lots of questions in the chat. So thank you for everyone that has contributed questions. They're all fantastic. I've responded to many of them. So if you have submitted a question before the presentation or during the presentation and it was specific to your account or your situation, I've answered it in the chat. So please feel free to take a look at those. But one thing I'm seeing a lot of is people looking for advice about what to do. And this is how the program helps you. We have many opportunities for you to get advice. We have online advice, which is available at no charge. It's a very user-friendly application. You can link to it directly from your abaretirement.com account. Work through some questions. This program helps you ascertain your risk and reward tolerance and will provide you specific advice on what you should invest in the program. We also, if you're a person that is uncomfortable making their own investment decisions, or perhaps doesn't have the time or inclination to do the kind of research you want to do to make sure that you're complementing your retirement strategy, we have professional management. You can hire a Voya retirement advisor to manage your account ongoing. That is a fee-based service, and there's more information available if you scan that QR code or visit us at our website. We also have financial planning for a more holistic financial viewpoint. So the advice I just talked about is very specific to your retirement account. If you're looking for someone to help you not only with your retirement account, but with your budgeting, perhaps you're saving for a wedding, your holistic financial viewpoint, we also offer that through Voya Financial Advisors, and that is also accessible through the abaretirement.com website. So I encourage you to familiarize yourself with all of these tools. They're great, and we also have a myriad of financial planning in our online learning library. If we could jump to the next slide, sir. Again, our website, you can ask us questions. We have lots of questions in the chat. For any we don't get to during this live presentation, I will reach out to you via email after the fact. So hopefully I will get to as many as possible. It's my favorite part of the webinars. I know it's Matt's too. But you can email us at any time at contact@abaretirement.com. I have a staff of 3 people that man that. They are fantastic and we're very responsive. You can also speak to any of our representatives by calling the 800 number listed on the screen. Our representatives are available from 8 a.m. to 8 p.m. And if you are not a client of ours, we welcome you to join the program, and you can email us at joinus@contactusretirement.com. That said, I think it's time, Matt. You ready?
Let's do it. Yeah,
All right,
excited.
let's jump. There are some important disclosures. I encourage you to read them when you get them in your copy. There's no way on God's green earth you're going to be able to do it right now. So go to the next slide, please. All right, let's do it. We have 14 questions in addition to those that have been submitted previously. So I'm just going to go through as many as I can, Matt. And if you need to punt, you need to punt.
Okay.
Let's do our thing. Okay.
All right.
Most of them are for you, by the way. So
Okay. Fun.
lucky you. Please comment on the growth of new ETFs and what type of risks and benefits some of those newer models provide.
Sure, yeah. So ETFs it's an interesting, it's a vehicle for pooled investing. So they're similar to a mutual fund, but the key difference is they're traded like a stock on the stock exchange. So you can get pricing at every minute that the stock market's open. Whereas mutual funds, you can only invest once a day and you sort of get the price at the end of the day. But for a lot of other intents and purposes, they're very similar. They're actually regulated under the same financial regulation. Where ETFs are gaining a lot of popularity because they can be a little bit more tax efficient. They tend to pop up a lot less in 401k plans because 401k plans are already tax advantaged. And also the 401k environment is really set up to be it's set up to be long-term savings vehicles, ETFs, because you don't really need that daily trading piece of it. And I think they started off being a lot more, used by retail investors and folks who wanted to market time or be very tactical and buy, different exposures. I want to buy just broad technology for a couple days. An ETF may be an efficient way to do that. And the market is launching a lot of new products because people are buying them and they're easy to set up and they're tax efficient. But it just is a little bit less applicable in our view to a long-term 401k retirement vehicle.
Thank you. And I'll add, we didn't really get into the brokerage component of the program, but there is a brokerage arm that savvy investors can use to complement the core investments that are part of the main strategy of the program. And you can purchase ETFs through that brokerage arm, and that's a Schwab vehicle. This one's for me, kinda. Roth versus traditional, and you can chime in if you'd like to, Matt. What
Okay.
are the benefits? Previously, it was recommended that young people sign up for Roth, but older people in higher tax brackets should not. There is now a new point of view that older people closer to retirement should have funds in Roth that are not taxable for easy withdrawal without tax consequences. It really depends on your personal financial situation, what you can afford to contribute after tax, because obviously one of the benefits of saving on a pre-tax basis is that you're saving on the taxes now. You can do that if you're in a position to do that now. It really does depend on your personal financial situation. I love Roth personally for me because it's tax-free growth. Um, I am not a young person anymore, despite my outwardly youthful appearance.
Neither am
Um,
I.
but but I am a fan of Roth, but it really depends on your personal financial situation. I love it because if I've already paid taxes on it, I'm not going to worry about what I'm doing when I am required to take distributions. Matt, I don't know if you have an opinion
Yeah,
on it,
I,
and it
I
really is just
really,
an opinion. So
yeah, it's a personal, everyone's tax situation is very, very unique. So I encourage you to contact your accountant or your personal financial advisor to work through what's best for your situation.
agreed. I should mention, just while on the topic of Roth, because Secure 2.0 changed so many things, if you are if you are of catch-up age, meaning over 50, and you made more than $150,000 in FICA wages last year, your catch-up is required to be Roth. So I do want to note that because it's a new rule, and I know that we're getting a lot of questions on it on the client service team. So bear that in mind that if you are in that population, you'll be required to make Roth contributions. Ooh, this is 100% for you. The implications of the Davos Economic Summit to U.S. economy.
So yeah, it's a tough one. I mean, a lot of it was overshadowed by talks of Greenland. And I think that it's hard to understand an economic benefit to acquiring that, but I think what it does is further push international investors away from the United States, so away from the US dollar, away from US assets, and them really trying to diversify that if the US is not going to be the world's premier trade partner, financial partner, because they're going to use that integration as financial leverage for other types of deals because the world banks through the United States, the world saves in the US dollar, the world saves through government bonds, and they have for decades because we are the most, historically the most stable, partner for all that. The
Mhm.
fact that that confidence has been shaken recently is causing folks to sell the US dollar, sell US assets, and start to diversify into other areas. And I think it's just sort of a rational economic response to the US using that financial connectivity as leverage for other negotiations. You saw that with Russia too. People point that out. I know it's kind of universal that we were all on the same page about that. It was kind of consensus that that probably should be done, but the U.S. was very much able to kind of shut off all foreign reserves that Russia had because of how, connected the U.S. is to the financial system. So I think it just like that sort of conversation, I think overshadowed a lot of what happened at Davos and just continues a
Yeah,
trend that was already happening of folks looking to diversify outside the States.
thank you. When you consider funds, how far forward or backward should you look with regard to rate of return? 1 year, 5 year, 10 year? Should you have your own funds allocation versus employer funds allocation as different percentages to different funds? I'll speak to this a little, but then I'll ask you to weigh in. Past performance is not indicative of future performance. Don't chase performance.
Yep.
You want to look at the objective of a fund, the investment strategy and methodology, more so than reviewing historical performance. So if you're struggling with where to put your money, call our advice team. They are there for you to support you. You can have as many consultations with them as you like. There's no fee to speak with someone and get some advice over the phone. But I would not personally look at the 1, 5, and 10 year for anything other than helping to determine what their overall strategy and adherence to their objective is. But Matt, I
Yeah,
welcome
I
your
agree with that.
input.
I'd caution against performance chasing. Mean reversion is probably as close as we have to economic laws of physics. So things that nothing does well forever and things tend to revert. You just saw that this year with international equity. So if you looked at international stocks versus US and said, wow, these things look kind of lousy, they haven't really kept up with the US. And then all of a sudden it flips on its head in 1 year. And in looking at even into this year, international stocks continue to do well. So commodities also looked pretty poor until gold was up 64%, right? So I think that just having a good plan and having a well-diversified portfolio is the right
Mhm.
way to go versus trying to focus on let me buy the fund that's done the best recently.
Yeah. Speaking of international stocks, timely. I've heard that international stocks have been doing better recently. Why is that?
Yeah. Yeah, I talked about it a little bit, but just to kind of reiterate the points, I think weakening US dollar is going to help. And a lot of that weakening US dollar comes from, like I mentioned, these folks diversifying outside of the United States and saving in different currencies and saving in different government bonds than the United States. So all else equal, if I bought a share of um, Airbus out of France, and they earn a euro of revenue and the US dollar is weaker, that euro of revenue is more US dollars if the US dollar depreciates. So mechanically, when the US dollar gets weaker, international investments do better. But also I mentioned valuations. When something hasn't performed as well for a long time, it's cheaper. So you can just get a better value. So if you want to buy a really strong financial, you're going to have to pay a lot more for a share of JP Morgan than you'd have to pay for BNP Paribas right now. So you've seen a lot of that mean reversion. The other kind of they're also different secular trends, like I mentioned, in emerging markets. Some of the world's best companies, Samsung, TSMC, I mean, these are really excellent companies that do amazing things. And if you're not internationally diversified, you could miss out on some of those opportunities too.
Awesome. Thank you. Ooh, we got quite a few.
Mhm.
Let's do this. Okay. Do the core fund risk assessments ever change? Does a high risk fund always stay high risk?
I I think in the short term, they can look higher risk or lower risk, but over a really long period of time, you would expect that continuum to generally hold pretty true. There certainly could be times if rates markets are extremely volatile where, bonds may exhibit a little bit more shorter term volatility than maybe large cap equities. But over a very long period of time, just sort of the nature of the asset classes, we would expect them. And we publish sort of forward-looking assumptions for all those different types of investments. And over the
Mhm.
long run, we think it should hold generally true.
Yeah. And obviously, the retirement date funds would be the exception because
Yeah.
those are designed to become progressively more conservative as approach the retirement year.
Yep. Good call
Yeah.
out.
Yeah. You did already do this, but I don't know if you want to like just mention a couple high points from your presentation, but please discuss the outlook for US equity versus foreign equity near and midterm.
Yeah. We're moderately constructive on equities globally. Um, but then it's hard to put your foot in the sand and say, or put a stake in the ground and say definitively if you're more optimistic on one or the other. I think valuations are in favor of international. The US dollar, even though it has fallen, is still relatively strong, so it could fall a little bit more. So those could be beneficial for international equities. If TSMC keeps rallying and some of the advantage emerging market tech players continue to keep rallying, that could benefit international stocks. But at the same time, a lot of the massive AI spend is happening from domestic US companies. So I think valuations and the currency is on the side of international. Some of the tech spending is on the side of the US. And I would caution against, putting all your eggs in one basket or the other and just having a well-diversified portfolio.
Yeah. Speaking of AI, again, these timely questions.
Mhm.
Have I been getting exposure to the growth? And you may not know this off the top of your head, but have I been getting exposure to the growth in AI and tech stocks in the retirement date funds?
You definitely are. And it may not be it will be a pretty meaningful part. It depends on where you are in the glide path. If you're a younger participant or you're in one of the later dated funds that has a lot more equity, you have a very large allocation to all the US technology stocks. So you own a lot of Apple, Amazon, Nvidia, Oracle, these companies that are really at the forefront of technology. They're well diversified right out of the box. So they have international exposure. So you're going to have TSMC, Samsung, SK Hynix, MediaTek, these are all Taiwanese and South Korean technology and semiconductor names too. You have exposure to all those.
Awesome. Thank you. Does Mercer have an opinion on the 2026 financial markets and if the S&P as well as emerging markets will continue to lead? Will the Russell 2000 finally be back on top after a long lag behind the S&P Mag 7 in the last many years?
Yeah, hard to predict. I mentioned kind of the US, non-US stuff, so I'll probably focus a little
Yeah,
bit more on small caps. Small
of
caps are actually
course.
doing really well this year. And it's a similar phenomenon to international stocks. Small caps have kind of gotten beaten up on a relative basis. So they've underperformed US large cap stocks. There's a couple reasons for that. There's just not quite as many interesting AI plays in the smaller cap part of the market. But it's good to have it again as part of a diversified portfolio. All of our, pre-mixed portfolios are going to have some exposure to small caps too, just as a good diversifier for periods like the start of this year where small caps are starting to rally.
You know, if I have a if I have a pension and investment with the FRS, can I transfer this account to my ABA retirement account? I will take that. Yes, you can roll most qualified plans into the ABA Retirement Funds program. And we actually have an account consolidation team that will help you do that. If you call us at 800-348-2272, it's on the slides, or you reach out to us via the contact us email address, we can help you. But yes, we can accept most qualified rollovers into the plan and help you consolidate all of your things in one place. With interest rates coming down, how might this impact the bond options offered in the program? It's a great question.
Sure. So it's kind of a double-edged sword. So when rates come down, one of the good things about high rates is that when rates are high, bonds have to yield, a high amount too. So if you were building a bond portfolio 2 years ago, you could have locked in 10-year bonds, 20-year bonds, 30-year bonds that paid a pretty healthy rate of interest. If you're to try to build that same portfolio now that rates have come down, you're buying bonds that have lower rates. But the converse is if you own a portfolio of high yielding bonds and rates come down, your bonds are worth more because I own some of the ones that were issued a few years ago when rates were high, and now you can't buy these anymore. You have to buy them from me, and I'm going to charge a premium for them. So what you see is a dislocation between the price of the bonds and the yield of the bonds. So it helps from a capital appreciation standpoint. So your whole basket of bonds will go up in value, but as you start to collect coupons and as you need to start reinvesting that bond income, you're investing it at lower levels. So it's not necessarily a bad thing in the short term for rates to come down, but as a long-term bond investor, rates coming down means you're just going to earn a lower rate of return on your bonds. But you'll get kind of the one-time, jump of the bonds appreciating in value.
Okay, so we have a follow-up question, and it's revisiting the performance one. So how does the past performance, 1, 5, 10, indicate overall strategy or adherence to objectives? What are you looking for, and how does that guide your decisions?
Yeah.
So I think the question is really like, what are you looking for? And maybe we can help with what information we provide to give you that data in making your investment decision.
Yeah, I can talk about there's a bunch of different types of funds and you have to sort of measure them and evaluate them differently. And I think looking at it from the tiered objectives lens is a good way to do it. So do you want something that's more pre-mixed, like the retirement date funds? You could look at the individual funds if you feel comfortable setting your own risk and return targets and doing your own asset allocation. Then you can make a decision on active versus passive management. So if you're comfortable paying some fees for active management for the potential opportunity to outperform, you could evaluate that fund, using the fact sheets or the offering document. There's
Yeah.
information about how the funds have performed, and that can help you make an informed decision about what types of asset classes you might want to be active or passive therein. What have historical returns been? It's all just information you can use to build your mosaic of understanding, and help you have confidence when you're putting your portfolio together. Or you can
Yeah,
call
I think.
Voya, I think, and they can help guide you around the menu.
Yeah, I do think that's well said. We do, and we don't probably promote these enough, but we do share the Morningstar profiles online, and you can access those through abaretirement.com. The Morningstar profiles give you like a nice one-sheeter on, it's a fund profile. It will give you some information about historical performance. It will give you the objective of the fund, who the fund managers are, asset allocations within the fund, expenses, obviously, top 10 holdings. It's a really nice snapshot that can help you make a decision. But overall, investing can be complicated, and the advisors are here to help you. Even if you don't want to speak with an advisor, the online tool is super easy, and it can get you acclimated in using some of the tools and resources that we have to help you make informed investment decisions that are suitable for you. So I hope that answers your question, but if not, please email us at contact@avaretirement.com and we'll get back to you. We have two more. You ready, Matt?
Let's do it. Let's wrap it up.
I've heard that gold and silver have been going up a lot recently. Will any of the investment options in the program benefit from this?
Yeah, there's going to be a handful that have varying degrees of exposure to precious metals. So within the standard equity funds and within the target retirement date funds and the target risk funds, there's actually going to be very small allocations to gold miners in there. So you will get a little bit of exposure. But really, the fund I would point to is the real asset return fund. And that fund is meant to be a diversifying fund that has exposure to real assets. So infrastructure, real estate. Think about physical assets. And then part of that is a sleeve of natural resources and commodities too. So you'll have actual direct exposure to oil, to natural gas, to agriculture, to precious metals and industrial metals. You'll also have access, a more direct exposure to some of the miners and producers of, energy and precious metals and industrial metals as well.
I know this isn't true, but whenever I think of gold miners, I think of like an old-timey prospector. Like that's not who
Yeah.
like you're investing in. Like you just have to
No,
like
yeah.
reframe my brain that it's not like an old-timey prospector with like a pan in the river. Okay, last question. What do you see as being the biggest risks to the market currently?
So I think tariffs are going to be part of that, but I think kind of broader is this sort of it's kind of what played out during the Global Economic Forum and has been playing out throughout the course of this year, and that's these the more transactional nature of the way the U.S. is dealing with our historic allies and dealing with our historic trade partners. I think that we've benefited and the world has benefited economically from the rules-based system, and it has some flaws for sure, but I'm not convinced that the sort of polarization and the sort of spheres of influence approach and using the strong using financial leverage against weaker countries is going to be a particularly prosperous one going forward and can work in the short term. Because the U.S. is such a strong and deep market. I'm not positive it's really in our best interest or anyone's best interest in the long term from an economic standpoint, just given how powerful free trade, free flowing of ideas can be as a strong economic generator and has been since the end of World War II. So I know that's kind of a big concept, but I do think
Yeah.
that this sort of diversification away from the United States and the U.S. stepping back from global institutions um, could have some longer term, pretty serious impacts on our standard of living and economic growth in the United States.
Yeah, that's a great response, Matt. We did have another question. I'll take it because you just did the really hard ones. What is your opinion about 401k loans? Um, okay, so they're there for all the right reasons. If you need to access your money, it's most of the part it's your money, you're entitled to it. But when you take a loan from your 401k, you're taking it out of market, so you're no longer earning anything on that dollar amount. Further, when you are repaying your loan, you are repaying that loan with post-tax dollars, which is fine. But when you are older and you take the money out, you are paying taxes on that money again. So while they are there for all the right reasons, I don't view 401k plan loans favorably. That is my opinion. Um, Matt, do you have an opinion on 401k loans?
I share your opinion. I think it's if you need it, you need it. It is your money. But if you can possibly do, I actually had this conversation with my friend recently. You had to replace all the windows on his house, and he mentioned, I could either take it out of my savings or I
Expensive.
could take. Yeah, I think it was a lot more than I thought, to be honest with you. But
Yeah, brutal.
yeah, he's like, I have the savings to cover it, but I was thinking about keeping my savings because it makes me feel safe and taking a loan for my 401k. I said that's what the savings are there for. And I started,
Hmm.
again, it's his money. He can do what he wants with it. And he ended up taking it out of savings and not touching his 401k because that really is for retirement. It
Yeah.
really needs to grow and he's going to be happy. He's going to thank me 30 years down the line that, he took it from
Yeah.
somewhere else, but it's always there if you need it.
Yeah. And it's funny that you say that. I'm sure he's a younger person too. But compounded earnings is really like the premier benefit of having this long-term savings vehicle.
Yeah.
And people that start earlier and keep their money invested, unquestionably do better than those that don't. So, um, they're great. If you need a loan, they're there. It's your money, take it. But if you can avoid it because you're going to need that when you're older. No one pays you to retire, it turns out. So here we all are.
Mm-hmm.
Um, okay. Well, Matt, thank you so much. You're, as always, quite knowledgeable, and it must feel like being back in college getting grilled with all of these questions, and you did exceptionally well. So thank you. And thank you all for participating in our webinar. We're happy to have you. Please reach out to us at aba.abaretirement.com. Call us. Call the advisors if you need advice on your specific situation. We are happy to help and would love to hear from you. And we look forward to seeing you on our next webinar. Thank you so much. Have a great day.